Did you know that about half of the banks in America are holding about 15% of their Tier 1 capital in this asset class? That's a very significant amount of the market and a very significant amount of their capital.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
Welcome to the Financial Freedom Roundtable. I'm Russ Morgan. I'm going to be one of your hosts today. We're breaking down the greatest scam banks have ever fallen for. It's a $200 billion scam. And you think Bernie Madoff got away with something? Clearly, the life insurance companies have. When you think about the amount of money, $200 billion, according to the latest study of how much bank-owned life insurance there are. Here's what I'm going to say. Obviously, that's tongue-in-cheek. If you know anything about what we do, we help people who want to become financially free get there faster. They have to set up a system for their cash flow to flow. We use the infinite banking concept as a method of putting money to work prior to going and buying assets to produce passive income that exceeds your monthly expenses. I always love it when people tell me, well, I want to check out the math. I'm like, what are you talking about checking out the math? Do you think the banks have some of the smartest investment minds around? They're putting over $200 billion in cash value life insurance. You go look it up. It's under BOLI, BOLI, bank-owned life insurance. To verify the information I'm telling you, they've already done the math. So you don't have to figure out, does the math work? What you have to figure out, does it fit for you? So today we're going to be talking about why banks are quietly loading billions of dollars in life insurance, what they're doing with it, and one other thing, which is really important, is how does this apply to you? How many summers do you have left with your kids? 10, maybe less?
And are you spending them together, or are you still stuck in the office while time slips by?
You want freedom. That's not the problem. The problem is you don't have a system that buys back your time. Without it, 3 years from now, your kids will be older and they won't care that your business was more successful. They'll remember you weren't there.
That's why we built the Passive Income Operating System, the plan we use to create over $50,000 a month in passive income. The system isn't free, but the training that shows you how it works is, and it's under an hour.
Go to wealthwithoutwallstreet.com/PIOS. Take the first step to buying back your time now. I'm not here by myself. I'm surrounded by the dream team of financial coaches. To my right, I got my partner, the Italian Stallion, Mr. Joey Murray. Stallion, good afternoon.
My breath. Always good to be with you.
Stallion, why do you think talking about BOLI, of all things, is a topic worthy for the podcast today?
Well, in case you just misheard Russ in his Montgomery accent, we're not talking about a little ball with 3 holes in it that you roll down an aisle. We're talking about bank-owned life insurance, okay? And here's the reason why this is important to you, is success leaves clues. Banks, as Russ already kind of pointed out, they've done the math, they've done the research, and this is where they're parking billions and billions of dollars. In fact, I recognized this when I was at Wells Fargo so many years ago, 2009. I look up, and on their balance sheet is $19 billion of life insurance, when they only had $11 billion in real estate. That was an aha moment for me. And here's the thing. I want today to be the time where you just follow the breadcrumbs.
That is so good. That is so true. I remember telling you that, and you're like, wait a second. These same monkeys around here have been telling me not to do life insurance. I have all this life insurance on them. We're going to get to that in a second. But let's bring in the dream team of coaches. I got downtown Ernie Brown. Good to have you back on Earth.
It is good to be back.
Ernie, why, in your opinion, is this conversation important for us to cover?
It's important today because yesterday I got to have lunch with a guy that I go to church with. We're eating a delicious turkey, bacon, cheese, fried egg burger together. And the conversation steered towards money. He paused, realizing that that's kind of what I do. And he asked me, hey, can I ask you about something? I've got X upcoming with money, and I'm thinking about doing Y with it. What do you think about that? And it gave me an exposure again that both X and Y were very normal, very traditional. This is what everybody thinks about doing with money, except for me. It's about the exact opposite that I would think about doing with money, but it's what everybody else is doing. So this is important because the inside the box thinking that everybody knows is absolutely not what the most successful banking institutions, extremely successful companies, extremely successful individuals are doing with money. This conversation is it's an opportunity for a completely different shift in your paradigm, the way that you think about money. Or, Russ, these banks really have been scammed. We got to figure that out.
That's right. Well, speaking of scamming, we have a former client who's become a coach on here. He must have been scammed in order to participate in this as a client. And then now he's a proponent of this. I mean, the only reason he's talking about this is clearly because he gets paid, but also he gets paid doing a lot of other things like real estate. He's our resident real estate expert, Mr. Jamie O'Brien. Good to have you back on, Jamie.
Man, good to be here, Russ. I appreciate that outstanding introduction.
Well, you obviously coming from a client's perspective before, stepping over to the dark side is what some people would say. I think that, light always overcomes the darkness. And I feel like we sit in a perspective of being a lighthouse for most people. They've been running into the rocks. Why do you believe this conversation is important for us to cover?
Well, to be clear, I'm not here just because I get paid to do it. I actually love what I get to do. And part of that is helping coach clients around what I call becoming the CFO of their family finances. And we talk and we work with clients who want to become financially free and help them get there faster. And we do that in steps. And we say you cannot skip steps to becoming financially free. And one of those steps is creating a cash flow system, which we use and help people implement the infinite banking concept. And I just said infinite banking concept has the word banking in it, right? And so when I think about implementing this concept, becoming the CFO of our household, we need to think like a banker. One of the things I walk our clients through is thinking about how banks work, right? We have to understand what banks are doing with their money so that we can follow that success, follow those breadcrumbs, as Joey just said. When you think about banks, they have the biggest buildings in the city, some of the smartest people, massive profits, right? Super successful. And we really just need to model exactly what they're doing. And so I'm hoping that this episode will give some insight into what they're doing, why they're doing it, how banks use life insurance so that we can apply it in our personal lives as well.
Well, let's talk about what banks are doing with life insurance. So, Ern, I want you to go first. What's one reason you found that banks are buying bank-owned life insurance?
Well, they're doing it because they've got money and they need somewhere to put their money. And they are seeking safety, guarantees, predictability, looking to improve their balance sheets, to up their ratings. And so what they know is that certain forms of permanent life insurance give them all of these things. So that's why they're doing it. So what are they getting? What's inside this that makes it so good? Well, first, there's a guarantee on their money. In fact, when these banks put their dollars in this place, that's classifies as tier 1 capital. We'll break that down in a minute, but this gives them guaranteed access to cash liquidity, guaranteed growth, tax efficiency, protection on their key people, and a death benefit on the back end, which is good for everybody. And so this is becoming the place for them to put their money. In fact, did you know that about half of the banks in America are holding about 15% of their tier 1 capital in this asset class? That's a very significant amount of the market and a very significant amount of their capital.
Well, you talk about that. One of the things I think people don't understand about life insurance companies is the majority of these carriers have been around 150 to 175 years, right? Like compare that to the Fortune 500, where the average corporation has been around like 15 to 20. Right. I mean, so the stability of these companies, the fact that they've been around, they've gone through all the ups and down cycles that we've seen as a country, right? That banks are trying to participate in that as they should, right? Like we want our money that we put in a bank to be safe. I love exactly what you said. And that's a huge area. Jamie, what's another reason banks are buying life insurance?
Yeah, I mean, really, banks are looking for efficiency of a dollar. If they can do multiple things with $1, they're going to try and do that. And so, to Ernie's point, they're storing a good amount of money in there. One of the things they actually use this insurance for is to offset cost of employee benefit plans like 401ks and deferred comp. And so they essentially use these life insurance contracts as a self-funding mechanism for benefits. They're going to get the policy growth over time that's going to fund future obligations. And then they're going to get a death benefit when that insured dies that's going to replenish the pool of these employee comp plans. And so over time, this literally creates a self-sustaining system. And it's tax deferred. It's a tax deferred fund with a tax-free replenishment at the end. And so this really allows banks to turn what used to be an expense into an asset at the same time.
Yeah, that's so true. I don't know if people know this too, but banks have been bailed out by insurance companies over time, right? So when banks were going belly up, the insurance companies were the ones that were able to help them with their balance sheets. I just saw another stat here I thought was pretty interesting. When you look at three of the largest companies out there, Apple, Amazon, JP Morgan, they have a little over $4 trillion in assets. Well, the top life insurance carriers out there are carrying over twice that on their balance sheet. So just giving you scope and size of these companies. How much passive income do you have right now? And if in 5 years you're still at the same point, what's that going to cost you? Maybe more time at a job you hate or missing moments with your family?
See, most people don't move because they don't know what to do. So they just keep doing the exact same thing.
That's why we built the Passive Income Lab. It's a 12-week program where you are guaranteed your first $500 a month in passive income.
But here's the catch. It's not open to everyone. We only let in 10 people at a time.
So the real question is, will you be one of them? Apply now at choosepassiveincome.com.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Joey, what's another reason why banks are using this strategy of buying life insurance?
Well, I'll tell you, there's at least a couple more reasons, and there's probably some we don't even have time to get into some of the nitty gritty here, but a couple of reasons. One, it's a tax efficiency play for them. Think about this. Cash value grows tax deferred. The death benefit, which is on all these key employees, to Jamie's point, are gaining benefits and bonus plans and things like that from these vehicles. The death benefit is tax-free to the bank. Now, you compare that to things like, bonds or treasuries. Those are producing taxable interest. That's their primary way of making money, is through loan interest, but then bonds and treasuries have this taxable interest, which would lower their after-tax returns. Whenever they use the capital in bank-owned life insurance, they're reducing the tax drag, right? They don't have nearly as much that they have to earn because it's strengthening their balance sheet by having it there. That this non-interest income is what we're talking about that they're able to gain. That's the second thing that it does. So not just tax efficiency, it also gives them diversity for their interest income, their sources of income. So think about how we always talk about how do banks make money? They make it off of loans. Well, that's interest income. And so by having this additional form, it gives them the ability to diversify. It improves their return on their assets and return on equity. So if you think about like this, for you would want to have multiple streams of income. That's exactly what they're doing. They're stabilizing their profits and they're giving themselves less volatility through different market and rate environment cycles.
I want to give you one more reason why I love life insurance companies is, have you ever heard of this concept of wealth without Wall Street, Stallion?
Yeah, I feel like I've heard that before.
Insurance companies carry uber low percentages of their money in any of the market-based securities that the average consumer is carrying 90 to 100% of their total asset portfolio. I love that. Again, following what the most wealthy and most stable businesses over our country's history are doing with money. Like, come on. Why wouldn't we love them? All right. But the person listening to this is saying, okay, well, it's good for banks, right? Well, I don't have billions of dollars. I don't have this, marble floor and a nice, fountain out in front of my house necessarily. So maybe it's good for them, but it's not good for me. Is that true, Ern? So how could you apply maybe for the person who's thinking, well, banks have tier one capital, and I can't afford to, they can't afford to lose it. How could they apply that to themselves today?
If you're not forced by external regulators to keep a certain amount of tier one capital, that doesn't mean that you can't self-regulate. So this can apply to you if we know that the ultimate reason that businesses fail, number one reason that banks fail as well, is when they run out of cash. And if you're pursuing any measurable success, like businesses, like banks, then you would want to keep cash to keep yourself from ever running in that situation. So is there a level of tier one capital that you would force yourself to keep? And if so, where would be the best place to keep it? To Joey's point at the very beginning of this episode, he said success leaves clues. We can absolutely replicate this model and keep significant amounts of safe, liquid capital in similar forms of life insurance on the key people in our lives to give us all the efficiency, all the protection, all the safety, all the growth, all the same advantages, and again, self-regulate. But when we do that, we get to make the rules, and that's better for everybody.
No, that's so good. So we're talking about this, Jamie. You said, okay, there's banks are using this to ensure some of their key employees will and offset other costs. How can the average person listening apply that same measure?
Yeah, well, I mentioned earlier that I think about myself and try and get my clients to think about themselves as the CFO of their household bank, right? The CFO of the family bank. I would call that a pretty key employee. So having insurance on that person to take care of the family is important, in my opinion, to begin with. But the offsetting cost is really recapturing lost opportunity costs because most people are storing cash in checking, savings, high yield or not, bonds, things like that before they invest the money if they're trying to be an investor. But that money's not earning a whole lot. And when they take money out to go and make the investment, the balance drops and the compound growth stops on that money, right? Not to even mention that the growth during the interest gain during that time is taxable. So if we use properly designed life insurance, what we essentially are doing is doing two things with $1. We're allowing your cash to keep compounding uninterrupted the entire time so that you can use it simultaneously through loans for investments and or other opportunities. It eliminates and we recapture that opportunity cost of using cash for investments. Your dollars are literally doing two jobs at one time. And so really, the analogy here is like banks turned an employee expense into an asset. You can turn your cash reserves into an earning asset while you invest as well.
That's so good. Yeah. How do you turn liabilities into assets? Man, I've had a lot of liabilities and I had to figure out perfectly how to do that every time. But I do know how to use assets to pay for liabilities. And, asset is anything that puts money in your pocket. So clearly, if this is an asset on the bank's balance sheet, it's something that's putting money in their pocket. So Stallion, you talked a little bit about that. So think of from the perspective of the person listening, how can they apply tax efficiency, diversification, stuff like that banks are using into their lives?
Well, before I jump into that, there's 2 steps that you need to do in order to implement this into your life to actually get to financial freedom. And we happen to be able to provide you with both steps, which is great, right? You have to have your own cash flow system. And that when you get that, go on to wealthwithoutwallstreet.com/PIOS. Go sign up there, get a specific coach to walk you through your own money traps and things to get your own capital into your tier 1 capital reserve that we're talking about. And then secondly, you have to become an investor. And we just happen to have a 12-week course that gives you your first $500 of passive income when you qualify. And you can apply at choosepassiveincome.com. I don't want you to miss this opportunity because we're talking about some pretty high level stuff here that banks are doing, but don't miss the forest for the trees. This is about you, and this is about you applying what they're doing to your life. And here's the 2 practical steps to do it. So now you talked about before, what are banks doing? You're using this for tax efficiency. Well, you get the same principle, right? You get to choose where your cash resides before it goes out into the world and produces passive income. You can either do that in a saving or checking account where you're going to be taxed and you're going to be paid much less in interest. Or you can put it in life insurance. So you can earn 3 to 5% tax free, which would have to be a 4 to roughly 7% taxable return anywhere else. And here's the question I have. When was the last time your bank paid you that amount? The answer is never. It will never outpace what the life insurance company is going to pay you. So it also gives you flexibility like the banks are doing. They're putting this money in to create diversity. And that is essentially like you creating multiple streams of income. So use this as your hub, as your investing hub, and give yourself the flexibility and liquidity to go invest in whatever asset class you want. Don't make the mistake of putting money into a place that is restricted, that requires you to only invest in certain things that, by the way, Wall Street wants you to invest in. These are the opportunities, funds that you need to put in place because banks know a little bit about that. And you could just, again, this is just one of those breadcrumbs to pick up along the way.
Oh, guys, this has been so helpful to kind of break down the reason why are banks putting billions of dollars in life insurance? And to answer the question, does it work? Well, we don't have to worry about does the math work? We're answering the question, how does it fit for you? So as we start to wrap this up, I'd love to kind of hear some final thoughts. What's one last thing that you would leave our audience with, Ernie?
Very simple. You can begin by defining what your own Tier 1 capital needs are. You can set that aside. You can evaluate using this to be the storage place for that.
So good. Jamie, final thought.
When I was a kid, there was a saying that I heard a lot from my parents and older individuals, and it was, do what I say, not what I do. I think in this case, we need to do what I do, not what I say, meaning the banks are telling people to save money in the bank. Yeah, they're saving their own money inside life insurance, right? At the tune of $200 billion, and they don't tell you about it, right? And so I think we really need to think about and really take into account what the banks are doing and move and redirect our funds into a safe, secure, tax-efficient, long-term storage container.
Well, one of the biggest financial entertainers out there has a knack of trying to beat up on the life insurance industry and talking about what a scam it is and how people should put zero money in there. And I heard him in a street interview recently declare that he may be a billionaire. And when the guy asked, where's your investments at? Like, talk a little bit about that. He went on to talk about how, his business and his real estate was worth roughly $1 billion. And I thought, that's kind of interesting. He was a billionaire and all of his money is in real estate and business. How much of that could be in the thing that he's telling people to put their money in, which is the stock market and mutual funds, growth stocks, stuff like that. And so to your point, do as they do, not necessarily as they say. I like that. Stallion, final thought.
And I'm just going to quote our friend Nelson Nash, great mentor, where this all started from. And he's like, be the bank. Start thinking like a banker. Don't continue to operate as a consumer only. You have to also be a banker. Do not give up control of your capital. Build your own bank, your own private family bank, and do so by listening and doing what the banks do.
Yeah. So if you're using this concept and someone comes up to you and they tell you that you've fallen for a scam, just smile and say, me and the banks are full into it, but we'll just ride this one out. All right. I hope you had an enjoyable time listening to this. This is a conversation that is definitely one that we need to break down deeper every single week. It's something that as you're applying this in your life, it's not going to go away, that people aren't going to tell you that you're participating in a scam, but there is ways for you to understand what others are doing, especially successful people. But if you're listening to this for the very first time and you're like, maybe I have fallen for the scam of believing that it was a scam and I need to get on a call. I need to figure out, does this fit, right? Don't have to worry about the math anymore. Does this fit for me? Go to what'swaltwallstreet.com/free call. One of our coaches love to have a 45-minute strategy call with you to help you walk through, is this the right next thing for you? Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.